Whenever I see those crazy headlines about massive AI breakthroughs, I always find myself wondering, who is actually writing these multi-billion-dollar checks? I mean, we hear a ton about traditional venture capital, but the reality of global tech funding, it's much deeper, way more complex, and frankly, absolutely fascinating. So today, in this explainer, we're going to completely pull back the curtain on the hidden players powering the future of tech.
Okay, let's dive right in and look at our roadmap. We're going to use an iceberg model today. We'll start at the visible tip with the AI investment race, dive below the surface to the rise of family offices and funding physical AI infrastructure, plunge all the way down into the deep plumbing of the private credit engine, and finally we'll explore the hidden risks and vulnerabilities resting right at the bottom. All right, starting off with Section 1, the AI investment race, the very tip of the iceberg. To really understand the hidden mechanisms below, we first have to appreciate the sheer size of the capital being deployed right out in the open. $1.03 billion. And get this, that is a seed round. Literally a seed round. Usually those top out in the low millions, right? But this was recently raised by AMI Labs in Paris to build AI alternatives to large language models. It is the largest European seed round ever, and it perfectly sets the stage for the massive scale of money we're talking about today. And this massive influx of capital, it isn't just going to software and chatbots anymore. It's driving physical AI. We're talking actual robots trained on huge video data sets. Rhoda AI, for example, just secured a $450 million Series A to do exactly this. When you add it all up, the first quarter of 2026 alone is on pace for over $25 billion in physical AI and robotics funding. The traditional venture capital system simply cannot sustain this kind of volume by itself. Which brings us to Section 2, the rise of family offices, just below the surface. We are diving beneath the waterline here to reveal the hidden players who are actively bypassing those traditional VC funds. Now, when you hear single family office, or SFO, you might picture a cozy little home study. Actually, scratch that. These are absolute private wealth management juggernauts serving one ultra-high net worth family. Thanks to massive liquidity events, like huge tech acquisitions or IPOs, these families aren't just handing their cash over to fund managers anymore. They're building their own institutional-grade investment teams and deploying capital directly. And this is creating some really fascinating new global syndicates. You've got tech billionaires like Jeff Bezos and Azim Premji investing directly side by side with European industrial dynasties, like the Molliers family behind Decathlon and the Dassault Aviation family. Combine that with Gulf ruling families investing heavily in regional digital infrastructure, and wow, you have a completely new global capital map that entirely bypasses the traditional gatekeepers. So, let's look at Section 3, funding physical AI infrastructure. Basically building the grid. The crucial point to understand here is exactly where these families are targeting their wealth. They aren't just buying software apps, they're buying the heavy metal required to make AI actually work. We're seeing super sophisticated quantitative trading families treating data centers and GPUs as a core asset class. Take Nscale, an AI infrastructure hyperscaler that just secured a $2 billion Series C, backed by hedge fund families like Citadel and Point72. They want defensible moats, energy, raw compute. They're essentially financing the picks and shovels of the AI gold rush. But here's the multi-billion-dollar question, right? Building data centers and buying tens of thousands of advanced microchips costs an absolute fortune. So what happens when the equity, even from the deepest family office pockets, simply runs out? How on earth do these companies afford the billions needed for hardware? That leads us right into Section 4, the private credit engine. We're now entering the deep plumbing of the iceberg. We're transitioning away from family office venture capital and into the highly complex and honestly kind of murky world of structured debt. Enter private credit. Think of it as non-bank direct lending that's negotiated completely behind closed doors. It operates entirely outside of public markets or standard bank loans, and it has quietly become this massive unseen engine loaning billions to tech companies so they can actually go out and buy specialized AI hardware. $8.5 billion. I mean, just think about the sheer scale of that number. That is an $8.5 billion debt facility for a company called CoreWeave. In pure finance speak, it's called a senior secured delayed draw term loan, which Morningstar DBRS assigned an A-low credit rating. But in plain English, it's a massive credit line designed specifically to fund the acquisition and operation of data centers across places like Virginia, Georgia, and North Dakota. Okay, let's walk through how this actually plays out step by step, because it brilliantly grounds all the AI hype in pure financial reality.
First, CoreWeave gets this massive loan. Second, they use that cash to buy high-performance GPUs from Dell and NVIDIA. Third, they turn around and lease that compute capacity to Meta. And finally, Meta's take-or-pay contract payments are what actually service the debt, assuming strict uptime requirements are met. It is a closed-loop financial engine powering the physical build-out of AI.
Which finally brings us to the bottom of the iceberg. Section 5, Hidden Risks and Vulnerabilities.
It's time we objectively examine the hidden floor here, looking at the macro risks that have global regulators so on edge. To really grasp the risk, you have to look at the sheer size of the entire private credit market. The Financial Stability Board estimates it sits globally somewhere between $1.5 and $2 trillion. Trillion with a T. That is a staggering amount of interconnected non-bank lending.
And when we look specifically at AI, we absolutely have to highlight this sobering metric. A recent working paper from the Bank for International Settlements noted that the AI race generates significant overinvestment. They estimate it exceeds the, quote, socially efficient level by around 50% under a conservative baseline. So when you combine $2 trillion in private credit with a potential 50% overinvestment in a single sector, yeah, you can see why regulators might start to sweat a little.
The core issue really boils down to a stark lack of transparency. In public markets, you have publicly rated borrowers, totally transparent leverage metrics, and strict regulatory data. But in private credit, borrowers often lack public ratings altogether. They frequently rely on payment-in-kind loans, where interest is literally paid with more debt rather than actual cash. It creates this massive web of hidden structural leverage that financial regulators simply cannot easily monitor.
And these hidden plumbing risks remain largely untested in a real economic downturn. Think about it. You've got unknown direct bank lending to private funds, documented at around $220 billion, but the real number is likely double that. Then, default rates are quietly trending upward when you look at distressed exchanges. Plus, there are huge, real-world operational risks. If a data center doesn't have a fixed power contract in place, they are incredibly vulnerable to sudden, devastating spikes in electricity costs.
So, as this entire AI investment race continues to unfold, I want to leave you with one final provocative question. Will this massive influx of untraditional capital from family offices, combined with a multi-trillion-dollar private credit engine, be the solid foundation of a new industrial revolution? Or are we actually looking at the catalyst for a hidden financial crisis? Definitely something to think about. Thanks so much for exploring the depths with us in this explainer today, and we'll see you next time.